Hello, everyone, and welcome. This is Financing Philadelphia's Future. Thank you for coming. We have been doing this for more than a year, these monthly conversations about the Philadelphia Public Bank. It's going to happen. We know it is. I'm Vanessa Lowe, your host. I am the co-chair of Power's Economic Dignity Strategy Team, and I also have a radio show called Vanessa's Money Hour on G-Town Radio. Welcome, welcome. This show is sponsored by the Philadelphia Public Banking Coalition that has done so much work to get us where we are, which is a successful piece of legislation, voted 15-1 by City Council to create the Philadelphia Public Financing Authority. So today we are welcoming Andy Toy. Andy Toy is the policy director at the Philadelphia Association of Community Development Corporations, PACDC, for those of us who know about CDCs. He's also been the with the Community Development Fund, development director at the Southeast Asian Mutual Assistance Association Coalition, CMAC. And before that, he was managing director of the Community Center Crane Project at the Philadelphia Chinatown Development Corporation, PCDC. His resume is so long and we only have a half hour, so I won't do it all. I'll let him tell a little bit about himself. But at this point, what we're going to do is turn it over to Andy. And really, we're hoping that Andy can maybe uplift some of the things about community development corporations, what they are, and how a Philadelphia public bank might help. Before we do that, I do want to point out that there's some overlap between Andy's board members. Dina Schlossberg and John Chin are both on Andy's board for PACDC, but they're also candidates for the Philadelphia Public Financing Authority board. So lots of overlap there. Andy, I'll turn it over to you for some opening remarks.
Sure. Well, thank you very much, Vanessa. And thank you, folks, for having me. Thanks very much for hearing what we have to say or what I have to say. And a lot of it may have been touched on in the past, but hopefully I'll bring some additional wisdom or thoughts that can help us move this process forward. First of all, thanks to Stan Pokras, Stan Shapiro, Peter Winslow, for including us in the conversation and reaching out early on. And we certainly supported the effort to pass the bill. And of course, it was Derek Green that really helped to push it forward, and as he did with the Housing Trust Fund bill. So we've been fortunate that some really positive things have happened in the past year, and we want to keep going on that positive track. So a couple piece of background for me, and I think this is why it's sort of a good fit for what we're talking about. I've worked at a number of organizations, including LISC, the Local Initiative Support Corporation. There's a whole bunch of alphabet soup here, unfortunately, but LISC is a funder and supporter of community development on a national level. So we used to do underwriting of loans and grants to CDCs and other organizations. So a basic understanding of what you have to look for in terms of lending and in financing is important because that's where the public bank can come into play. I'm also on the board of the Merchants Fund, where we actually have done one loan so far, but mainly grants for small businesses. And then I was on the board and on the staff of the Enterprise Center in a previous life, which really the focus of the Enterprise Center is access to capital for minority businesses. And that is really what a lot of what we're talking about here. And at PACDC, all of our work is done through an equity lens. And really, as we all know, there is a lack of capital access in minority and especially Black communities in Philadelphia, Black and Brown communities. So part of our effort is to try to level that playing field a little bit, as much as we can. And it'll keep going in the wrong direction if we don't do something in a positive way. So that's sort of the big picture. Another big picture item is that we know that there are some efforts underway because of issues such as Black and brown home ownership going in a downward trend percentage-wise in Philadelphia, that we need to do something about that, because that is, one, the road pathway to wealth, and two, the pathway to stability in communities. And three, actually, is the pathway to, if you want to be an entrepreneur, having a property is, I used to work at the Commerce Department in previous life too, and people would come in and say, hey, I want to start a business. I have very little capital. Where should I go? And I'm like, well, the bank's going to ask you, or the lender's going to ask you, what's your collateral? And without that real estate or some foothold in terms of capital, it's very, very, very difficult to start. So having more access, more ways to fund folks to get them on that road is really important. So I like to look at in terms of capital. You know, when we were doing underwriting, we'd look at basically what banks look at is maybe what some people call the 5 Cs, which is, oh boy, have it somewhere else. And sometimes it's 6 C's actually, but character, which is like your credit history, and capacity, which is your income, your monthly income. Can you pay the loan? Capital, which is what you have in hand. If you have nothing in hand, then it's very difficult. Collateral, which could be your home or some other securitization, and then the conditions, which are like the interest rates and what's happening if there's a recession, you know, and so that's all laid into the whole idea of risk and what a bank or a financier is willing to put up in terms of risk. And I like to look at in terms of the importance for community development financial institutions, which are kind of the go-between that sprung up after banks wouldn't lend to many places in inner cities or in certain neighborhoods, redlining basically. CDFIs have taken an important role, community development financial institutions. We have a bunch of them in Philadelphia, which are great, and everything from the Enterprise Center to PACDC, Philadelphia Industrial Development Corporation, to West Philadelphia Financial Partnership, which is called something different now, Community First Fund. There's a whole bunch of them. Anyway, they also have to look at the risk of lending. And so what can we do to mitigate that risk kind of as in some ways? And one of the ways that capital can be used, a bank, perhaps a public bank institution, would be to find a way to mitigate that risk by either maybe paying down the interest rate on the loan, or maybe helping to pay, help people to get a home first, you know, to really have a home ownership stake in order to be able to, let's say, start your business. Or even if you're just buying your home, you know, there's a number of things that can be done, helping to pay for some of the upfront costs. And the city already has some programs that are just come online with this, which is great. But there's always a need for more, and there's always a need for filling that gap. And this is where a flexible funding source can come into play. And I think that's what's often missing, you know, especially like if you go to a bank, and honest to God, this just came up about 15 minutes ago. I was reading an email from my previous employer who's they're trying to buy a building, and I won't name the bank, but they said, oh, well, we see that you've got like all this debt on from the last 2 years. And it was the PPL loan. It's a loan, PPP loan. And it's a loan. Yes, it shows up as debt, but it's actually a recoverable, I mean, a loan that can be forgivable. And that most of them are. So this idea that there was some debt on the books is just like crazy, but it's a bank. So yeah, kind of expect different from a public bank, I hope. Right. Yeah. And folks on the boards, including some of our friends and possibly some of us, would be helpful in understanding that and really looking at that closely. So that's sort of the bigger picture. I think let's see, there are other ways, like if somebody has a limited credit history, we can help perhaps fix that. Other areas where banks and other lending institutions are limited, it would be in financing things like mixed use properties, where it's not a residence per se, and it's not a business. And sometimes the financing is much more difficult for that, or a property that needs to be renovated. I can tell you that I bought a property, my very first property, many years ago. And I bought it through Atlantic Financial was the mortgager at the time. There was a company called Atlantic Financial, and they had a really great product, which was a loan that was a renovation loan, and then it turned into the mortgage later on, and combined the cost of the purchase plus the renovation and became a permanent mortgage. I don't see that product around, so maybe there's some opportunity there.
Right.
And then another area where there's opportunity, I really believe, will be as we loosen up our rules to make it more possible for people to do affordable properties, such as accessory dwelling units. Let's say somebody wants to age in place and they can't afford to stay in their home to pay for the upkeep, the roof is leaking, or the taxes are going up and they're on a fixed income, but they want to stay in their neighborhood. Accessory dwelling units and other zoning options, making it easier for somebody to actually carve out a space and rent out to, let's say, an affordable unit upstairs while they stay on the first floor, would be a really great option, a tool. But unfortunately, in most of the city, you can't do it by right. And even just to go down that road is expensive. Just you think about, trying to get a permit, and then you also have to have an architect to draw plans and all that stuff, even before you even get the funding to do the work to put in a kitchen or another bathroom. And so that's why ADUs are really hard to do right now. But if there was a source of financing for that and a setup, it could make it possible for a lot more people to age in place, which would be awesome. So I think it is about being creative and having the ability to do more with what we have, and leverage what's already happening out there. You guys have probably heard about the Worth initiative, which is essentially the focus is 5,000 new homeowners of Black and Brown homeowners by the year 2025. And that's funded in part by Wells Fargo. And there's a Convergence Initiative, which is very similar. The Mortgage Bankers Association is coming into Philadelphia to try to push forward. Again, these are ideas, but we need to leverage more than just that. And then there's upcoming Trident Mortgage. You might have heard about how they redlined in Philadelphia, particularly Black communities. So they are actually obligated to put some money into helping people to purchase homes. So if we can figure out a way to connect to those efforts, I think this fund would be great. And there's more. I probably shouldn't keep talking. We need some time.
Let me jump in. Thank you, Andy. You've given us a lot to think about, and there's already questions that are rolling in from the community. But Peter, be prepared. I'm going to turn to you for questions. But let me go back a bit. And you, as the policy director for the Philadelphia Association of Community Development Corporations, tell us what CDCs are. A lot of people hear like, oh, a CDC. So technically, what is that? It's not a CDFI, a Community Development Financial Institution. The other thing that people get confused by, and I know I get confused by it, is so I think they can do both community development that is affordable housing or housing, but they can also do small business. So help us understand CDCs, because I also want folks to know that they probably have one in their neighborhood. Go ahead.
Yeah, just a second. Let me just turn off that noise.
Okay, sure. All right, Peter, you've got some questions lined up for us when he gets back, right?
You do.
Sorry about that.
That's okay. That's
That's
okay.
that's my landline, which
Of
I never
course.
use. We never use.
Have
So first of all, yeah, I forgot to go backwards a little bit. So PACDC, Philadelphia Association of CDCs, is basically a membership organization representing about 50 plus what we call community development corporations and about 100 other associate members. So it's about 150 member organization. But CDCs actually are, there's really no pure definition of a CDC. It's a community development corporation is a nonprofit that works in community development. What is community development? It could be anything from social services to preschool, to food, to employment, to commercial corridor redevelopment. But what we know, what most people associate with CDCs is housing. And the most, I guess, the most capable CDCs in some ways are the ones that actually do real estate development, which is much more complicated and takes capital and expertise, especially if you're putting together a capital stack that includes things like low-income housing tax credits or some other very complex but usable financing, but the cost of doing that is tremendous, both in terms of money and in terms of capacity. So not everybody can do that. What would be great would be another opportunity for some financing that was not so complex. Because when you go to low-income housing tax credits, we were just talking about this today in the office, actually. Generally, you're talking about 50 units or more, just because there's an economy of scale for all the paperwork and everything else that you have to do after the fact, even. So CDCs, yeah, are organizations embedded in communities, absolutely, and that the reason why LISC came about, by the way, is because banks were not financing projects in communities. They were like, well, these are very risky, low-income communities. And LISC was looking at it and saying, the people that started LISC were saying, well, no, it's actually not that risky because we're financing an organization that's embedded in the community. If things go south a little bit, they're not stepping away. They're not going to drop it and walk away. They're there. And in fact, it's been proven out that community-based organizations doing projects, sometimes really hard projects, are way more successful. The default rates are minimal, and even if they do, they come back and they figure it out and they fix it. Whereas a private developer will walk away from the project, honestly.
Right.
That's what CDCs are. I know.
Okay.
Yeah.
So that's good. I want to point out another thing, but clarify another thing about sort of a community development corporation. The board needs to have community members, right? So that may be one of the factors around, like, well, they're not just going to let it go. Like an outside developer is like, yep, we're not making our money on this. These are community members who are making the decisions. Is that part of the general standard for a CDC?
Generally, quite a few members, if not everybody, lives in the neighborhood. So,
Right.
Not all CDCs, but and there's certainly a mission. They're mission-based organizations, so they're not about just making money, and that's not the point. It's about improving a community. So that's really the important factor in why they will keep at it, even though some project doesn't make sense sometimes.
Got it. And I want to get back to the stack question, because I think that's really where we could talk about what the Philadelphia Public Bank could be. We could be a layer in the stack, but we'll explain that after we maybe get at least one question from Peter. I know we've got a couple coming in. Peter?
Thanks, Vanessa. We have 3 questions and a comment that all relate to the housing issue. So it's all really on target. Relating to the stack, if I can synthesize the questions a little bit, where do you see that the gap arises in putting together all the financing that's needed, the debt and the equity portions of financing that's needed to do any kind of project, and the differential between home ownership and rental, within that stack and the way in which the projects are conceived. And if I understand you correctly, you agree that the commercial banks, for the most part, are misassessing risk in a variety of ways in terms of how they do their underwriting, and that that perception can be corrected by the imposition of the financial authority.
Yeah, just starting with the last part first, I think banks do serve a purpose, of course, and I think sometimes, and we've seen this, I've seen this, where they will insist on taking the first position in a mortgage, let's say, in a financing scheme. The second, a CDFI or some other organization, and I'm not sure if the public bank would be, because I'm not sure if you're going to do any direct lending, but maybe an entity that's connected to the public bank could come in the second position and mitigate the risk of the bank and say, look, the 20% we're going to take will be the part that doesn't get paid back if only 80% gets paid back. But we see this as a project that's worth this risk, and we see the character of the people, the first C, which I think is really important. It's a Wonderful Life was all about the first C. It was about finding the character in the people, and then you knew they were going to find a way to pay the loan back, even if it didn't seem to make sense on paper. And that's what CDCs are about. As well as somebody that lives in a neighborhood that sometimes it takes more wraparound as well. So it's not just CDCs also, and other organizations like CDFIs actually kind of work hand in hand with people. A bank is less likely to do that. And the other thing is, a bank is any kind of lender is looking for a larger project generally, because it's for the same amount of work, you're getting a much larger loan, let's say, and the lender, the loan officer can say, look, I did like 2 loans this year for like $10 million, I'm done. But in neighborhoods, maybe it takes you 20 loans to do that, and that's great, but it's a lot more work. So sometimes you need that extra incentive, maybe, and maybe the gap can be filled as a second second position, or as I said, I think one thing that's interesting that I would like to see us do more of is now that interest rates have gone up a lot, is write down interest rates somehow, and I think it means that you're paying a lower monthly amount, and maybe you pay a little higher monthly what you would have paid initially, and then after 5 years you basically can pay off that with the amount that difference would be like it's about a 5-year payback perhaps for 1% difference in your loan. If you understand what I'm saying, and then from then on you're actually paying at a lower rate. So I think people we have to think about ways we can promote smart. There's an education component as well, actually, for people. But I think my bias is a little bit towards making sure that neighborhoods are stable through home ownership first. And then CDCs have a role to play in terms of building and supporting rental units that are affordable in communities. So there could be, for example, if the public bank came in at a very low rate for a rental project, taking a high amount of risk or leverage, but with that, maybe there could be a requirement: you need to keep this affordable for the next 10 years or 20 years or 30 years, whatever amount of time. And that's what low-income housing tax credits are about. But you could do that in an easier way without all the regulations and all that, and a less expensive way with some other entity that could be through the public bank. So I see that as a real possibility of usage.
Thank you, Andy. We've got 5 minutes left. This goes really fast, but I do want to point out, because we're having this conversation, one of the things that the coalition has done, the Philadelphia Public Banking Coalition, is we have started to have what we're calling People's Forum. So it's another way to have conversations with the community. Had the first one on November 17th, and it was the People's Economic Forum talking about affordable housing. We had 75 people on. Now, this is a different kind of format because it was a 90-minute discussion. So we had, I think, 4 different speakers, and then some conversation back and forth with the community like we have here. But 75 people participated. It was a vibrant discussion. And the link is going into the chat now so that you can go and watch that episode. We're going to continue these. It's going to be part of a series. The next one is not yet scheduled, but it'll be focused on cooperatives and small business. Andy talked about, this is something that maybe some of his CDCs are involved in. And yeah, I think this issue of where can the Philadelphia Public Bank fall in that stack is one of the big issues. But another big issue that did come up, and maybe if there's just sort of a brief comment, we know about, or we've heard about, the University City townhomes. Many people lived in this building for a long time. It was somehow tagged as affordable housing and it expired. So Andy, with you mentioning, it'll be affordable for 10 or 15 years. How could, sort of what's the issue around how can we make things permanently affordable? Because now that's being devastating for these families.
Mm-hmm. Yeah, I mean, that deal was made like 30 years ago. And essentially it was financing at low-income housing tax credits, I believe, that allowed that project to be built in the first place. What is happening is now some of these, the affordability requirements are expiring over time because we thought 30 years was a long time back then. And now it's not that long because they're starting to expire. And there's a whole group led by LISC, the Local Initiative Support Corporation in Philadelphia, that's looking at how do we, keep the affordable expiring units affordable through refinancing or what a lot of people have done is they re-up and they get some more funding to renovate, because after 20, 30 years, it definitely needs that. And then that requires them to keep it affordable for another 20, 30 years. But without that, I think it's up to the private sector in some ways. And if we could, in that situation, if there had been an angel that stepped in, or maybe still a possibility, we have a university over there. I'm not even going to talk about that, but
right. That I don't know about that.
I am a graduate, so but
they're no angel, right? I'll say it, and I'm a graduate from there too. Yeah.
I don't understand. Anyway. Well, I do think that with the right mix of financing and the right entity to sort of take it on, because there's a management issue as well. Yeah. There is a way.
There's always a way. All right, we have run out of time. These go so fast.
Man.
Andy, thank you so much for joining us. This has been really wonderful. We hope to have you again, maybe in one of our longer 90-minute sessions.
Apologize for talking too slow.
No, you gave us great information and great things for the board members to be thinking about, because that's the thing. The board is still, the bank products and services are still being developed. So we'll figure out those.
And I see lots of questions that I didn't answer. I apologize, but there is a list of they're putting together that list of expiring affordable housing projects. LISC is working on that, so we can talk about.
What we may do, Andy, is send you those questions, and then we can post your responses if you're willing to do those. All right.
Mm-hmm. Mm-hmm.
All right. Thank you all for joining us. Join us next month for Financing Philadelphia's Future, and stay on our list. Get on the Philadelphia Public Banking Coalition list so that you can find out about our next public forums. Okay. Thanks again. Bye-bye.